Alan Greenspan just died at 100 years old. 5 days earlier, the new Fed chair quietly reversed the exact move Paul Volcker made in 1979 to break inflation. 3 Fed chairs, 40 years of debt, and now it's about to land on you. Check this out and see what you think about this. The American household is carrying $18.8 trillion in debt, more than has ever existed on American household balance sheets in history. More than 1929, more than 2007, more than every prior debt cycle combined. And 5 days ago, the brand new chairman of the Federal Reserve walked into his first press conference and made a decision that hands the next move on every dollar of that debt to the bond market. If you have a HELOC, the bill is going to change. If you carry a credit card balance, the minimum payment is going to change. If you have an adjustable mortgage, your payment is going to change. If you took out a margin loan, a personal loan, a business line of credit, an auto loan with a variable rate, where you co-signed anything for a kid in college, your monthly number is going to change. And the chairman of the Federal Reserve just told the bond market it gets to decide which direction. Here is the part that should scare you. If the bond market decides rates go up because inflation is still elevated, because oil is volatile, because the Middle East is still on fire, every variable rate balance you have reprices higher. The household at $18 trillion in debt cannot absorb that. Not at this scale, not on these incomes. And if the bond market decides rates go down because the economy is cracking, because layoffs are coming, that's worse, not better. That means the recession the Fed is now refusing to forecast publicly is the one already in motion. The variable rate balance gets cheaper, and the job that services it disappears. There is no good direction from here. There is only the question of how the most indebted household in American history survives a Fed chairman who just said on the record that telling the market what's coming next is no longer his job. That decision was made on June 17th, 2026 by Kevin Warsh. 5 days later, on June 22nd, Alan Greenspan died at 100 years old. His wife, NBC's Andrea Mitchell, announced it that morning. Complications of Parkinson's disease. 2 events, 5 days apart. The chairman who spent the last 20 years of his life warning Americans about the debt stack he had built, gone. And his successor's successor, the same week, inverting the single most consequential move in modern Fed history. The move Paul Volcker made on a Saturday in October of 1979. The move that broke every variable rate American household once already. This is the 3rd time in 50 years that the Federal Reserve has handed the steering wheel to the bond market. The first time was Volcker. The household carried $1.4 trillion in debt. The bond market took rates to 20% and mortgage rates above 18%. Inside 20 months, every household on variable rate debt was destroyed. The second time was Greenspan, the slow version. 18 years of cheap money, household debt growing from $2.7 trillion to over $13 trillion under his watch. He warned us about what he built. He died on June 22nd. The third time is happening right now, against a household that owes 13 times what the Volcker household owed, and a Fed chairman who refuses to tell the market where rates are going. In this video, I'm going to walk you through what Volcker did that broke households the first time, what Greenspan built that loaded the gun, and what Warsh did 5 days ago that just pulled the trigger. By the end, you'll know which variable rate balances reprice first, what specific signals to watch over the next 60 days, and what to do this week before the bond market finishes calculating. Stay with me. The household that understands this has weeks to position. The household that doesn't finds out on the next bill. Let's start with the man Greenspan called the greatest chairman in Fed history, Paul Volcker. When Volcker was sworn in on August 6, 1979, inflation in the United States was running between 11 and 13%. President Jimmy Carter had just fired the previous chairman, G. William Miller, for failing to break it. Volcker was the cleanup man. The brief from Carter was simple: kill the inflation. Use whatever tools you have to. What Volcker did next is what every Fed chair since has studied.
He didn't raise rates. He changed the framework. On a Saturday, October 6th, 1979, Volcker called a secret, unscheduled meeting of the Federal Open Market Committee.
Hey, real quick, I just want to jump in. If you're in debt and you don't like it and you're sick and tired of it, I put together a course that's changed thousands of people's lives. It's the Dominate Debt course. I'm going to throw a link down below. If you want to try it and break this cycle of being in debt, check it out and let's crush it together. Now back to the video.
They came out of that room and announced that the Fed would no longer manage the day-to-day federal funds rate. From that day forward, the Fed would target bank reserves instead. The market would set the rate. Wall Street still calls it the Saturday night special. And here is what it actually did. The federal funds rate the Friday before Volcker's announcement with 11.4%. Within weeks, it was 13.8%. By April of 1980, it was 17.6%. It peaked at 20% in June of 1981. The Fed didn't set those rates. The market set them because Volcker had handed the market the steering wheel. The 30-year Treasury yield went from 10.29% in 1979 to 13.42% in 1981. Mortgage rates went above 18%. Housing transactions in America froze. Unemployment hit 10.8% in late 1982. The recession that followed was the worst since the Great Depression at the time. But inflation broke. CPI fell from a peak of 13.5% in 1980 to 3.2% by 1983. Volcker did the job Carter hired him for. The cost was the variable rate American household. A family that held an adjustable rate mortgage in October of 1979 watched their monthly payment nearly double by spring of 1980. The Fed had not announced a single rate hike. The framework change did it, the market did it, the payment reflected it. The households that survived were on fixed rate debt with cash buffers. The households that did not survive were on variable rates with no cushion. That is what Volcker did. The same playbook is on the table again. Now to the 18 years in between. Greenspan's tenure. Greenspan was sworn in on August 11th, 1987. He inherited a broken inflation regime that Volcker had already killed. His job, in effect, was to keep it dead, and he did. But the method he chose built something that nobody at the time recognized as a problem. Greenspan kept rates low, year after year, through the savings and loan crisis, through the dot-com bubble, through 9/11. When Greenspan took the chair in 1987, total American household debt was about $2.7 trillion. When he handed the chair to Ben Bernanke in 2006, household debt was over $13 trillion, 5 times bigger. The American household had absorbed an entire generation of cheap money, and the leverage was now permanent. Greenspan knew what was happening. On December 5th, 1996, he stood at a black-tie dinner in Washington and used a phrase nobody in financial media had heard before: irrational exuberance. He was warning about the stock market. The Dow that day was at 6,437. The Dow then ran another 82% higher before the dot-com bust proved him right. By the time the warning mattered, the leverage on top of it was already built. After he left the Fed, Greenspan kept warning. In 2018, he told Fox Business the country was moving towards stagflation. He told CNBC there was a bond market bubble. In December of 2018, he told investors to run for cover. The man who built the low-rate era spent the last 20 years of his life warning about it. He died on June 22nd. The Federal Reserve released a statement saying he helped establish the credibility that remains one of the Federal Reserve's most important assets. 5 days after his successor's successor inverted the move that built that credibility in the first place. Now to Warsh. June 17th, 2026, 5 days before Greenspan died. Warsh's first FOMC press conference. The Fed held the rate at 3.5 to 3.75%. The vote was 12-0, unanimous. The rate decision was the least interesting part of the meeting. He cut the FOMC's policy statement from 341 words at the April meeting to 130 words at his first meeting. It's a bit shorter, a bit simpler, and it dispenses with some older language, he said. Then he said the line that matters. We've dropped forward guidance. For 15 years, the Federal Reserve has guided the market by telling it where rates are headed. The dot plot, the chart showing every member's individual rate forecast, was the centerpiece of that guidance. Warsh kept the dot plot. He refused to put his own dot on it. I did not submit a forecast for me, he told the room. It's not helpful in the conduct of policy. The chairman of the Federal Reserve declined to forecast his own rate path. 9 of the 18 remaining dots projected at least one hike this year. 8 projected a hold. 1 projected a cut. Warsh was the 19th voter, and he abstained from telling the market what he thought would happen. Then he announced 5 task forces on communications, the balance sheet, inflation frameworks, data quality, and productivity. He's rebuilding how the Fed talks to the market from the ground up. Volcker handed rate setting to the market. Warsh handed rate forecasting to it. Different mechanic, same transfer. The difference is what's sitting in the back seat. Stephanie Pomboy at Macro Mavens called the Volcker comparison fanciful. Volcker could shock rates to 20% when household debt was $1.4 trillion. The math of debt service against $18.8 trillion means a much smaller rate move produces a much bigger household level pain. Jeffrey Gundlach at Double Line drew a different historical comparison this month. The current manufacturing data sits closer to the Arthur Burns era of the 1970s than to the Volcker era. Burns was the Fed chair who let inflation run loose. Volcker came in after and killed it. If Gundlach is right, that we're closer to Burns's data than to Volcker's, the question for the household is, which one of those eras Warsh ends up reenacting? David Rosenberg at Rosenberg Research compared Warsh's appointment to the 1987 handover from Volcker to Greenspan, the handover that began the era that built the debt stack we're sitting on right now. 3 economists, 3 historical anchors, 1 conclusion. The bond market is about to price something. The household has weeks before it lands. Here is what to actually watch over the next 60 days. The 10-year Treasury yield. That's the benchmark that prices the 30-year fixed mortgage and anchors most adjustable rate debt. When the 10-year moves more than 20 basis points in either direction inside a single week, the bond market is repricing in real time. Mortgage rates follow inside 2 weeks. The next FOMC meeting in July, Warsh will hold a second press conference. Watch whether the statement gets shorter again, whether his dot reappears, and whether the language on inflation hardens or softens. Either signal moves the curve before the rate decision matters. The August inflation print. Iran-driven oil prices feed into the August CPI release. If the headline number stays above 3% or accelerates, the bond market prices a hike independently of what Warsh says. If it drops sharply, the recession signal is the one Gundlach has been warning about. Your own variable rate balances. Every variable rate balance you carry reprices on a benchmark, usually the prime rate, sometimes SOFR, sometimes the 10-year. Find the benchmark on each balance you carry. Find the rate reset date. The balance that resets soonest after the bond market repricing is the one that hurts you first. The household that survives this is the one that knows which of its balances are exposed, which benchmark each one is tied to, and when the next reset hits. That information is in the original loan documents. Pull them this week. The bond market isn't waiting. That is what one Fed chairman dying on the same week another inverts his playbook actually means. Economic Ninja is out.